Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. I hope you had a wonderful, wonderful Labor Day, 3-day holiday weekend. It's now Tuesday. It's September 6th. We're now well into September. It's about 8:07 in the market. It's about 8:07 in the morning, and the market's going to open up in about an hour and 23 minutes to be exact with you. Now, you guys know the routine. If you're liking these videos, if you're enjoying these videos, comment below this video. For the love of God, I spend 10, 15 minutes a day doing these things. I want to see if you guys need something else out of it, if you're not getting enough value, if you have any questions, I'll answer it. Post a comment. You'll be surprised. You'll actually get an answer from me. And send me some emails, support@marketgeeks.com if you have any questions. Now, let's move on to today's video. As you can see here, the market's going to open up in less than an hour and a half, and the Dow is up almost 200 points, a little bit beyond random, and NASDAQ is up 76 points. S&P is meeting us in between. Now, the volatility, that's one of the things I want to take a look at, and that's one of the things that's keeping me fairly stable about this market, is the fact that volatility is actually going down and not up, even though the stock market has declined. Let me show you what I'm talking about. It's a major clue that the market is going to stabilize sooner than later. I don't know, I can't speak this morning. So here you could see this is here. Let me remove the RSI here. Let me make this a little smaller. Let me go to settings, display, make this small. Easier to see. So as you can see here, this is going down. Not really going up all that much. Volatility went from 416 to 480. It's not all that much. Look here. Look at here. Volatility goes here from 590 to 720. Right? Volatility goes here from 460 to 750. Volatility here didn't really go all that much. I mean, 402 to 465 or whatnot, it's not that much volatility. So that's telling me the market's not reacting all that much to what we're seeing right now. That's a good sign. And that's also a sign that means we could be bottoming out around here and going higher. Also, if you look at consumer discretionary stocks, this is the sector that I was talking about yesterday, noticing that this resistance area is now becoming the new support, which if it goes down a little bit lower, we'll be back into that range. But so far, it's holding up well. And most importantly, this is what you need to know, the bond market. The bond market, folks, look at where we're at right now. This is crucial, because here's the thing. If we break lower, then all those stocks and indexes and sector that I just talked about, they're probably going to go down to the base. If not, if we're going to bounce from here, then there's a good chance we're going to gyrate for quite some time. Now, today's an interesting week, and I'll get into momentum levels in a little bit. But today's an interesting week. We don't have a lot of reports, but we have the Fed speaking all over the place. Mester, Brainerd, Barr, they're all talking this week, and we've got jobless claims. But as far as data, we've got some OPEC announcements. We've got some economic data, but it's mostly going to be Fed, institutional trades and services, energy, international markets, and the Fed. Jobless claims, but honestly, jobless claims is not that much. Keep your eye on the bond market this week. Again, if we substantially break below right now, then we can really be in for pain. But if we just kind of sit around here, maybe go a little bit lower and then start coming back up, that's going to give stocks a little more time to adjust to the current interest rate scenario without losing their cool. If you look at the percentage of stocks, this is momentum levels on any stock trading above $2 in the stock market. Momentum levels look like they have more to go. But the bottom line is we're not overbought anymore. We're at 37th percentile. And on the 200-day line, we're even lower. We're at 26th percentile. Now, looking at individual sectors, notice I said a few weeks back that this is going to look a lot like this, and it is now. I don't think there's that much more downside to go, especially with momentum levels in consumer discretionary at 14%, real estate at 13%, communication services at 12%. I mean, we can go down, but I mean, look at real estate, 10%. Communication services 19%. So I think the bottom is we're very close to bottoming out and starting to go up again, and that means there's a stronger odds that the bond market will continue gyrating between the 120 and the 110 area versus going down continuously, at least right now. Let's talk a little bit about global economy, and then we'll come back into the analysis. So, global stock market, Wall Street futures rose Tuesday. Today's Tuesday, obviously. We had a 3-day weekend. And anytime you have a fragmented week, anytime you lose a Monday, it takes a few days to start getting along, especially on a long holiday, last summer fling. Don't expect a lot of volume till about Thursday. Friday is when we're going to see the market back on all, firing on all fours. Till then, it's going to be a little slow. But you got British Prime Minister Liz Truss is becoming British Prime Minister. European wrestled with uncertainty about Russian gas supplies. I feel bad for Europe this winter. European markets were jolted by Friday's announcement that the suspension of Russian gas supplies through the Nord Stream 1 pipeline would extend indefinitely. It's going to be a cold winter in Germany. Shortages have pushed up prices and weight on economic growth and puts more impact and more stress on natural gas. On Friday, the S&P and the Dow both lost 1.1% after government data show U.S. hiring slowed in August, but wages rose, which is pretty important. Forecasters say that the Federal Reserve might see that as evidence. More rate hikes is needed to cool inflation. That's at a multi-year hike. That's almost a certainty. I don't even know why people are getting all surprised about that. Investors worry that repeat rate hikes by the Fed and central banks in Asia and Europe to control inflation might derail global economic growth. So far, things have been holding on pretty well, though. I got to say, the fact that the bond market is in this range and has not broken down is a very positive sign for the economy. In China, the deputy director of the cabinet's planning agency said Monday it'll speed up the release of policy effectiveness to make up for losses caused by the epidemic in the second quarter. 2 years ago, they were so focused on railing in their big companies. Now they're trying to survive. Also yesterday, remember, there wasn't a holiday there. They don't have Labor Day in China. It'd be kind of funny if they did. Beijing freed up more foreign currency holdings of Chinese commercial banks for lending and trading by lowering the amount they must hold in reserve. They're trying to create liquidity. They're trying to lower reserves. They're doing anything possible to spruce up global economy, just like U.S. is. The central bank rolled back an increase imposed last year to limit speculative trading and restrain the rise of exchange rate of Chinese yen. The yen has declined since then, prompting Beijing to reverse course and try to support its value. Yeah, they're not trying to make the biggest companies into government structures anymore. They're trying to survive right now. Now, in terms of sectors, you've got energy, utilities, consumer staples. Looking at these visually, looks like energy's kind of choppy right now. Utilities looks like it's kind of choppy right now. Consumer staples looks like it may be done going down because this volatility move is a bit too much. I would expect a little bounce. Industrial and consumer staples look almost identical. Most of the stocks exhibited a lot of volatility on Friday because they went up and then they went down. I'm expecting today to be a little bit less, maybe an inside day where we don't have so much gyration and possibly a reversal to the upside. One thing I like about Friday is we made a higher high. Even though we went lower, we made a higher high. Typically, these wide range days, they reverse to the upside. So I wouldn't be too quick to get into this market just yet. I would wait for directional bias because with this volatility range, I want to see a change of course. Also, as I said, this is crucial right now. I'm going to tell you right now, if the bond market breaks lower, it's almost a guarantee that consumer discretionary stocks, this trend will loosen up and break lower. I think it's really great that this is holding up. I think it's amazing that ARK stocks are still within that channel and they have not broken down. But notice it's getting lower. See, notice we're going weaker, we're going lower. Look at bonds. There's no secrets here, folks. Weaker bonds, higher interest rates are very, very bad for tech and consumer discretionary. Now, tech already broke down there. But consumer discretionary, see, this is that range right here. Let me show you a better here. It's easier to see it without all this crap on there. There you go. See, it's in the middle of this range right here. But consumer discretionary is still above that range. See that? We're right there. So if the bonds break lower, if the bonds do break lower, it's going to push the rest of those stocks with it. And that's one of the reasons why consumer discretionary stocks are sitting right here. They're waiting to see if bonds are going to break lower or not. Now, volatility right now, volatility is not impacted by this very much. Volatility barely went up with this move down, which is very, very positive. And that's another thing that I've noticed with the ATR. ATR is not responding. That's telling me volatility is not responding to markets going lower as much as it did over the last 2 years. Also, as I showed you, momentum levels are already starting to get a little lower, especially in real estate, especially in communication services. There's just not much more to go. I mean, look at real estate. Where are you going to go from here? I mean, we're like really, really near the bottom here. And this is a 10-year chart. Look at that. Just doesn't look like there's that much more to go. So certain sectors should start waking back up near these levels, all right? Bottom line is, I think this week we're going to consolidate and possibly bottom out once again. Keep your eye on the bond market. The bond market is going to be the biggest clue, and momentum levels can go down a little more. So the question is, are we going to go down and hurry back up and come back down and come back up and go back to the 120 area on TLT, or are we going to continue a downtrend? That's going to be the biggest factor that determines this week whether the market bounces back or not. So keep your eye on the bond market and keep your eye on XLY. If the bond market starts breaking, consumer discretionary starts breaking, real estate looks like it's bottomed out at this point. Now, folks, this is it. And when I say this is it, I mean this is it. Folks, I'm getting together with Jack Carter one final time to discuss the S3 Advantage strategy and answer any questions you may have. It's happening at 1 p.m. Eastern Time. You'll get to see the system in action and even see what it's signaling. It's going to be very, very exciting. Given how much volatility we've seen in the market, I think most traders would benefit from a systematic approach that removes emotions from trading decisions, especially right now. So I urge you to check out today's session. It's going to be really, really hot. Use the link below to register. If you're on YouTube, it's in the descriptor. If you're on our website, it's below the video, and I'll see you soon. Comments, feedback, emails. I want to hear from you. I want to know if you're enjoying these videos. My email is support@marketgeeks.com. Bye, guys. Have a great day. Keep your eye on the bond market. It's going to give us the whole story. Bye, guys.